Good afternoon, everybody. Welcome to today's TIA live stream, the 3PL market report for the fourth quarter of 2025. My name is Anthony. I am the TIA host for the live stream today, as well as the senior education manager for TIA. We have a few housekeeping items to get through before we get started today. We're first going to run through the TIA antitrust statement. Discussion, comments, and presentations during TIA functions must not refer to any past, present, or future rates, prices, or anything related thereto, include any reference to marketing strategies, include any discussion of boycotts of any person, product, or firm, or inhibit any members' employees from discussing employment with other member companies. Additionally, things you hear during the meeting that are confidential and private to TIA should not be shared publicly without its prior consent or used against or in competition with TIA. Next up, we have a few options for you to submit questions throughout the presentation today. Please feel free to submit your feedback and comments in the comments section where you are viewing this on LinkedIn or YouTube. Or if you would prefer to email your question to education@tianet.org with the subject live stream, we will aim to get to as many questions after our presenter gets through the content scheduled today. And after today, if you still have questions, you are more than able to submit those when you're reviewing the recording. To review the recording, you can come back to where you are on LinkedIn or YouTube and review it as many times as you would like. Additionally, you can view other past live streams through the TIA LinkedIn account under events and by viewing the TIA YouTube channel and clicking past live streams. Be sure to follow the TIA LinkedIn and YouTube channel for upcoming live streams and visit tianet.org to check out the member resources we will be discussing today, specifically the Q4 2025 market report. If you are not a TIA member and you want to learn more, please feel free to also submit comments like that throughout the presentation, as we will be able to direct you to the correct person to answer your question. With that, I will turn it over to our presenter, Mr. Donald Broughton, for us to get started.
All for joining us. Glad to be doing this again. We have a lot to talk about today. It's been a very interesting time over the last 3 quarters watching freight flows start to develop. We have, for a period starting really in late 2022 throughout 2023 and 24 and really into 25, freight flows were okay, but they were not good. I mean, we had gone through a period, certainly in 21 and 22, and they were extraordinary. And so, if nothing else, it's kind of like that first day when in the fall when it's cold and you've been experiencing 80, 90 degree weather, it's suddenly 60. You think, oh, it's cold. Well, it's kind of like that's what it has been like, and what it's going to be like is this. That's going to be like that first day of the spring when it's 60, 70, and you've been experiencing 10, 20 degree weather. It's going to be like, wow, this is warm. This is awful nice. So we're seeing a real turn, and I'll show you primarily the TIA data focuses on truckload and less than truckload and intermodal. And of course, there's some other businesses in there that you all take care of. But I'm going to show you the whole waterfront, because it's important to understand that the patterns we're seeing in those modes is actually happening as well in other modes outside of what you guys normally broker. And it's happening in some of those modes on an even stronger basis. And I will tell you that throughout my career, I have again and again looked smarter than I know I really am by doing one very simple thing, following a basic rule. That is this. If goods are contracting, if goods flows are going down, the economy cannot be expanding. And if goods flows are expanding, the economy cannot be contracting. And so when we're getting a period like we are right now, which they all seem to be expanding, That makes us very bullish about the overall economy. As much as like, in 06, we got really, really bearish. And everybody's like, why? And I'm like, oh, things are really good. Unemployment's still really low. And I'm like, because all the freight flows are going ever lower. And of course, by time 08 rolled around, we looked way smarter than we were. That's the first thing. The second thing is this. You can learn a lot about the economy by looking at what's actually being shipped and where it's being shipped from and where it's being shipped to and who it's being shipped by. Something as simple as, looking at Asia Pacific air freight will tell you what's happening in the semiconductor industry, because if it's not all chips, but if it's not a chip, it's a thing that has a chip in it that gets air freighted in and out of that region. One. Another example will be lumber. Lumber shipments tell you what housing starts are going to be, because as a British client of mine once said, "Oh, that's right, you all stay and make houses out of wood." Nevertheless, you call your lumber supplier long before you call the county clerk to buy a building permit. You're telling the lumber supplier, "Hey, looks like I'm going to build more houses in the next couple of months, or fewer houses." Nevertheless, so that's the basics. And quite frankly, I just plug you all as brokers, as logisticians, you make it all possible, because any given person who routes freight, I used to route freight for a living at one point in my life. You have expertise, and when you find loads that are outside your expertise or within your expertise, but you've run out of the carriers you normally use, a broker is invaluable to allowing you to continue to be in business, continue to actually satisfy your customers, or keep the materials coming into the plant to keep the plant running. It's again and again and again. You keep people in business. You are the economy. You're the engine and the fuel of it. Nevertheless, all right. So let's start off with a big. Start with the first thing. Excuse me, Anthony. If you show the first slide. Oh, I try not to choke here. And Anthony, if you can you make that slide a little bigger so that people see it? Oh, there you go. Oh yeah, no, go back. So that first slide is this. That's good. Next slide. There we go. So we saw a pattern similar to the second quarter and the third quarter and the fourth quarter, although it wasn't quite as strong. Second quarter was really promising. Third quarter was downright in fuego. And fourth quarter is a little less. And I'll show you that data on a case-by-case basis as we go through the modes. But it still was up year over year, total shipments, but fourth quarter was sequentially slightly below third, just because third was a hard comp. And so that'll be a pattern you'll see again and again, but that's fine. First of all, recoveries don't happen smooth and are perfectly plotted out. But of course, they tend to go, markets don't go like this, they go like this. And that's exactly what we saw in this data this month, this quarter. What you got? Next one. Now, if you look at the total activity, that's exactly what I just discussed. It lays it out. That we're sequentially we're struggling, but we're up on a year-over-year basis. Now, that said, what's noteworthy is that margins continue to be under pressure. I think there's a couple of things going on here. First of all, when you're seeing demand rise, spot prices are coming up against you before you can raise the contract prices. And so, of course, your margins are going to be under pressure. And also, I think, quite frankly, the industry is at a place where many of you have gotten much more efficient in the way you handle a transaction. So you might have needed whatever, an amount, $50, $75 per transaction in gross margin at least, just to break even. And now you've gotten your cost per transaction down to maybe $5, $10, $20. I don't know, whatever the number is. So you can actually handle less. And so you're all being just more competitive. It's the marketplace at work and doing what it should. So that gross margin comes down a little bit. I believe many of you still have a net margin that's better after you put in your operating costs. But like I said, on the way up, your spot prices come up faster than you can move your contract prices. Next slide, please. All right. So this is the backdrop. I once had a trucking executive years ago when I first started left the industry, I left routing freight, and I started trying to write reports talking about the industry. I had a trucking executive tell me that he wanted to know two things. He says, if I know what retail sales are going to be, and I know what the ISM index is going to be, then I know what the demand from the consumer economy, and I know what the demand from the industrial economy is going to be, and I know how many loads I'm going to have. And you know what? Over the years, I've not only seen that to be true, but we've proved it out via math with our algorithms. So this is personal income. We've had personal income grow at a very steady pace. It was up 4.7% in 2025 versus 2024, and lo and behold, retail sales were up 4.5%. We had a period from 2023, 2024, in which really they diverged. They diverged by the largest magnitude for the longest period of time. Normally, personal income and retail sales go up and down in lockstep, and that's what that chart says. The correlation is 98.6%. It used to be over 99%, except that past little couple year period. But they're coming back together, and so we expect that personal income to go back to being the great predictor that it has always been of what retail sales are. And there's no reason to believe that personal income is not going to continue to grow. And unemployment's low, productivity is going up, wages are going up, inflation's coming down. So that number should be good. I wouldn't be surprised at all to see retail sales go up by another 5 or 6% in 2026. Next slide. And obviously that's great for trucking. So when you look at import containers, another way to predict what's going to happen in retail sales is look at the import containers. And import containers coming in are, whether you're the buyer at Best Buy or Nordstrom's or Amazon, you're trying to predict what people are going to buy and how much of it they're going to need. Or you're the buyer trying to figure out how much raw material you need to put into your plant to assemble or construct what it is you're going to sell to customers. And so any given period, this one or that one will be wrong, but collectively they do a great job of predicting what retail sales are actually going to be. And so when I see import container volumes going up and inventory to sales ratios are falling, then I know that those import container volumes are even more predictive than they normally are. And the predictive value is over 95% there. So next slide. Most recently, we have seen that is the second, third, and fourth quarters of 18, 19, 20, 21, 22, 23, 24, 25. What you will note is this. The record for those three quarters was in 2021. One, we had to do a little catch up from not shipping enough in 20, and two, we just had a boom. The most recent three quarters, and we don't pay that much attention to the first quarter because there's not as much demand. The real demand for the consumer comes as they're stocking up the stores for second, third, and fourth quarters. We in the second, third, and fourth quarter of 2025 surpassed the 2022 levels. Great news. And we came within 4% of the all-time high established in 2021. So that is very promising news. And when you look at the falling inventory to sales ratios, they're not just building up inventory, but they're actually selling things. Next slide. Now, why do you care? This is why you care. That is the correlation, long-term, the correlation between drive-in load posts in the spot market and import container volumes. They go up and down in lockstep. Now, more recently, you see that gap opening up that I talked about. Notice how it's closing again. And so, I expect that to go back to being 88, 92% correlated. And So as you see import container volumes continuing to go up, consumer income continuing to go up, you should expect dry van load post volume to go up. And obviously, I'm pretty sure every one of you will be happy if dry van load post volume is continuing to rise. Next slide. And that is the dry van load post volume. Oh, like coincidence, I happen to have it. This is what's interesting about it. Not only is it up, now it was up in 2025. It was up almost 6% versus 2024. But it's up even more. It was up in January, which is usually a weaker freight month, and it's up February above January. So we're right now running at 60%, over 60% above where we were in last February. Trailing 4-week moving average exceeds by 53%. I'm getting ahead of myself. 53% is dry van of trailing 4 weeks versus the same 4-week period in February last year. That's great. But it's also that trailing 4 weeks is 27% higher than the previous 4 weeks in January. And you all know February is the weakest freight month of the year for trucking. It ought to be lower, like 10% lower than January. And instead, it's 27% higher. That's phenomenal news. And it's also phenomenal news because this is the time of year when shippers are rebidding everything. So instead of going in there with your hat in your hand, when they're saying, "Well, I don't know, maybe we've got some freight. Are you suffering for some freight right now?" Instead, you can say, "I'm here to help you. Now you need to pay. You need to pay up." So that's the interesting thing right there. And we'll circle back to this thing. Go ahead, Anthony. Anthony Bueller. Oh, there we go. So let's look at the truckload segment itself. Just drill down a little bit. Truckload itself, again, this is trailing. I showed you some data that's just really just the last few weeks. We saw the volumes overall, they held in there. They were essentially flat with last year, and but you got pricing, and you struggle with margin a little bit. Again, this is different than what we saw second and third quarter, but it also kind of makes some sense because let's face it, when prices are going up as they have been, and demand is starting to get dynamic, shipping managers come to you so you can help them save their day. They don't lose their jobs. They got to get that load delivered, but they're not going to come to you with an emergency every day. They're going to try and figure out a way to negotiate long-term contracts with guys who are actually running the assets if they've got that load going that again and again and again. Those volumes come back. So as I said, recoveries don't happen in straight lines. They go up, down them, but it's still moving in the right direction. Next slide. And then of course this is the sequential, so a lot tougher. Like I said, the third quarter was quite a boom, and so we've come off that a bit. And again, same thing with margin. Spot prices are coming up faster than you can raise contract prices. Next slide. And so that's the rolling 8 quarters with all of the metrics. That's the gross. That's the rate per load and the margin per load. And right now they've been inversely correlated. I would note that up until 72 hours ago, fuel was relatively benign. It was either flat or slightly down, so it was no longer a factor in the rate. That of course will be different by the time we get the first quarter of this year and second quarter. But that the rate going up is more a function of demand. People say willing to do things longer lengths of haul over the road because they just need a hand to get it moved. They didn't have time. All good things, all good positives. But going right there, and next slide, and that's just volume. So you're getting carriers, shippers finding more permanent solutions after panicking in the third recover stuff. Next slide. Now, this is the other part of the story. remember I said this trucking executive, kind of guy who has tens of thousands of trucks and his own private jet, that kind of guy, right? He said he needed to know retail sales and what the ISM index was going to be. And this is one of the stories that I harp on because I don't think anybody's telling a story, and it needs to be told. And that is this. I'm sure that all of the negotiations that Trump has been undergoing have an effect, but onshoring was happening before tariffs. If you look at the amount we're spending, the first chart there is the amount we're spending on building brand new manufacturing facilities in the United States. It was plodding along pre-COVID around $5 billion a month. It's now over $20 billion a month. It is skyrocketed. And if you look at those other two charts next to it, that's the computer that you're putting into the plants. It's the electronic parts, pieces you're putting into the plant to run it. And there's another chart that's similar to that, those same shape. It's the machine tools, it's the conveyor belts, etc. If you look at the total investment that's being made in new and plants and new manufacturing plants and revamping existing manufacturing, completely revamping, we have in 2025 we spent over 825 billion on new or completely revamped manufacturing facilities, domestic ones in the United States. We're approaching $1 trillion. I wouldn't be surprised to find out that by the end of 2026, we've spent $1 trillion on new or completely revamped manufacturing facilities, domestic ones. That is onshoring because it means, one, we're committing to making more things, assembling more things here. And once you've built that plant, that means you're going to use it. That's very bullish for trucking because you got to move all the parts and pieces into those plants, and you got to move all the parts and pieces out. And there's a lot more moves versus just moving it from the port to the destination. And so that's long-term very bullish. And we're beginning, I think, to see that show up in the industrial side of the economy. The other thing that tells me that, and go ahead, one more slide, is chemical carload volume. It's almost impossible to run a plant of any size, any magnitude, whether you're making soft drinks like I did at one point in my life. Dr. Pepper 7-Up companies, we had big, huge tank cars full of caramel coloring and high fructose corn syrup and phosphoric acid came up on the railroad. But if you're making or assembling anything of any magnitude, manufacturing plant of any size, you've got a rail spur. And so chemical carloads tend to be a very good, not including petroleum, a really good predictor of what the ISM index is going to be. And as many of you may know, the ISM index surprised. It had been plodding along under 50 for a couple of years, and all of a sudden, boom, popped up to 52.6 this past month. And everyone's like, whoa, what happened? I'm like, well, it wouldn't be a surprise to you if you were looking at chemical carload volume. Next slide. The current chemical carload volume is approaching all-time highs. That tells me that we're having a resurgence in domestic manufacturing assembly. So if I'm having a resurgence in consumer retail sales, and I'm having a resurgence in the industrial economy, domestic manufacturing, and because of the spending on all those new plants that could have a reasonable expectation that it might continue, that's going to be damn good. That's going to be awfully damn good for trucking, but really for all modes. The other thing, and I didn't put a slide in here to talk about it, but I think it should be mentioned, that the dollar throughout, really since COVID quarantines, the dollar's been extraordinarily strong. We're literally up 40+% against the Japanese yen, 30% against the pound sterling. The only ones that were able to defend their currency were the Chinese, and we're still up 15+%, 20% against theirs. And that was because they kept selling treasuries. They owned so many of them. They'd sell the treasuries. They'd sell 90 to 120 billion in treasuries every month. And that would lower the value of the dollar versus their currency. But that behavior by them is over. And the dollar's starting to weaken a little bit. And weaker dollar means two things. One, we export more. We're seeing grain exports go up because, our commodities are more attractively priced relative to other countries when the dollar comes down a little bit in value. And it also makes this ongoing onshoring more interesting because if our currency comes down a little bit, then our net price to others is lower because they're buying our goods with euros or reals or British pound sterling, whatever they're buying it with. If our dollar is a little bit cheaper against theirs, it's essentially a discount on the things they buy from us. Next slide. That's also helping the industrial. So we're getting the same thing in LTL. And that also tells me, LTL is more industrial. It's less industrial than it used to be, but it's more industrial than truckload is. And it is it's been really pretty white hot for the last 3 quarters. And it's been interesting to watch the changes. We detailed in the report. I didn't put it in the slide presentation. Early on this year, the smallest of you out there profiteered and made really great margins on your LTL business. And then it seemed to be a shift towards more the mid-sized guys. And this past quarter, it was the large guys that made the most money. But the bottom line is all of you are making good money on your LTL shipments. Even though your volumes have come down a little bit recently, the margin, as you can see, the gross margin is up 30.7%. That's a 660 basis point jump in your gross margin. Even if you weren't controlling your costs, you made more money on those loads. So that's good news. And it's also, it supports the data coming in on from rails and others, suggesting that the industrial economy is starting to shift into second gear. Next comment. Next slide. So you see, sequentially, same kind of thing. We have sequentially the loads are down, but you're making so much more on the load, and a big spike up in the gross margin. So bully for you. I will warn you all though, that kind of a spike in margin, don't put that away as guaranteed, because you start making that much money, it's gonna motivate shippers to find alternatives, and 2, it's going to motivate each of you to find a more efficient way to do it than your competitors. That's the way the marketplace works. But that said, enjoy it while it lasts, because it is awful sweet while it lasts. But I suspect that the overall gross margins approaching 30% in the LTL will last about as long as a Dairy Queen Sunday on an August day. So go ahead. And so you get the comparisons there. You can see volumes improving, down up sequentially. I'm sorry, the revenue per load up sequentially, and year-over-year, and of course the spike up in margin. So it's smoke 'em if you got them. It's a nice time to be broker in LTL. And there's the volume. See if you see overall. Go ahead. And so then there's intermodal. Now, intermodal, remember, is primarily driven, at least domestic intermodal, is primarily driven by fuel price. And so it's been challenged over the last year and a half, 2 years, as fuel prices moderated and came down, spiked up with obviously the invasion of Ukraine by the Russians, but has steadily come down as the U.S. oil and gas industry has taken over and fracked. I don't know if you'll realize this, but we literally have become not only the world's largest oil producer. We used to be a distant third to Saudi Arabia and Russia. We are now bigger than Russia and Saudi Arabia combined. In fact, if you take the next 7 producers in the top 10 beneath Russia and Saudi Arabia, we're bigger than all of them combined. I also believe, this is just a sidebar, I also believe it may have had something to do with why we seem to be so active and so interested in exacting social justice for the Venezuelan people. Venezuela's in that top 10, and with what we're doing right now in Iran, having control of this Venezuelan oil in addition to our own resources means if the Iranians, for whatever reasons, have the ability to make things sticky in the Strait of Hormuz, we don't actually care. It doesn't give them the ability to kind of gut punch us. So it leaves our military many more options. 30% of the world's oil that moves in a tanker, moves over the ocean, moves through that Strait of Hormuz. So I'm sure that the Iranians normally, in a retaliatory move, would try to shut that down, try to make it difficult for us or anyone else to move oil through there. And because we not only are the largest producer, but also we essentially control Venezuelan oil at this point in the history, at least temporarily, we actually don't care as much. We can weather through whatever disruptions in the Strait of Hormuz that the current military actions cause. But anyway, if you want more intermodal, pray for higher oil prices. Nothing moves loads off the road onto the rail faster than higher diesel. It is a linear move, as y'all probably know. I think it's 6 miles for every 5 cents a gallon. Maybe it's 11 miles. I have to go look at the formula, but the bottom line is it's a linear formula. The higher oil goes, the shorter the break-even point becomes for when you move it off the road. However, I would also note that the demand curve is not linear. Demand curve, as you get to shorter and shorter lengths of haul, you get more and more and more. There are literally in the 600 to 500 mile length of haul. I'm sorry, in the 500 to 400 mile length of haul, there are more loads than there are in the 500 mile to 1,000 mile length of haul. As you get to shorter and shorter lengths, you get more and more and more loads. So as we get above 4.25, 4.50 a gallon in diesel, if we get that high, you'll see an explosion in this volume. Next. And there's the track record. Again, we have moderating prices, and oil are steady, so we don't use it as much. But nevertheless, you seem to be helping shippers out and making use of what is a very well-built network and mode, especially now that we're going to have a combination of Union Pacific and Norfolk Southern. That'll change the dynamics quite a bit. We're going to see even more competitive intermodal services than ever before, because there won't be an interchange in the Memphis, Chicago, St. Louis terminals. You can be able to run straight from east-west, west-east. Next slide. And last but not least, this is the international air freight. The dark green line is Asia Pacific, and the light green line is the Eurozone. This is very important, and here's why. Air freight is 1.5% of the weight of the tangible goods economy, but it's close to 20% of the initial value of the economy, because you're shipping chips, iPhones, you're shipping valuable things. That's why you're air freight. But that's the initial part. When you ship someone a brick, you ship someone cement, a 2x4, they put it in a house, they put it into the road. It's one transaction of economic value. When you buy the latest greatest NVIDIA chip, you're buying software, you're training people. There's things that happen afterwards. There are multiple transactions. Not only is each pound of air freight that moves way more valuable than each pound of coal, but it drives more and more economic transactions, prosperity, productivity, and it drives you to spend more money investing in. Just as I showed you those plants, they're putting computer chips, AI, automation in those plants. And what are they going to do in the coming years? They're going to make a lot of things very efficiently. And so this is very important to watch, especially Asia Pacific, because that's primarily what that traffic is. What I will note is this. We saw a bigger decline in the Eurozone, almost over 40% from the peak in 21, 22, down to the trough in 23 and 24. And then we did in Asia Pacific. It was only 30 there, but 35 there. But in the most recent months, not only has the Asia Pacific fully recovered, the November volumes in Asia Pacific, despite tariffs, despite all that going on, all that hootenanny, hit an all-time record high. So I can look at what's happening right now in the semiconductor industry, what's happening with AI and building data centers, and I can say, wow, at some point, that's a bubble. Eventually, yeah, sure, of course, all things ebb and flow. But this data tells me that it's not a bubble yet, or at least it hasn't popped yet. It's still extraordinarily strong. Next slide. And there's the data. That's over the last, I'm sorry, we only have 20 years of data for you. The correlation to 83%. That is our freightometer that measures the Asia Pacific air freight numbers. We data scrape the top 80% of the cargo airports in the region, and then we build an index that follows it. And we've been doing so for I still had hair when I started this. And you track that with semiconductor billings, and yeah, lo and behold, it's telling us the semiconductor billings are actually going to be higher in the coming months, and that's very promising. So, in short, what I've got is this: I've got strong air freight, I've got strong container freight, I've got strong truckload. I didn't put the reefer in here, but the reefer is even more than dry van. We've got strong LTL demand. I've got strong chemical volume demand. I've got strong, when all the freight flows are expanding the way they're expanding. I'm not saying it's not possible. We could have some horrible terrorists in it, but given what's happened right now and happening right now in freight flows, it means the chances of us having a recession, at least in the next 3 or 4 quarters, is as low as it can become. Nothing's ever impossible, but all of those who spent 4 or 5 years talking about, oh, the sky's going to be falling next quarter, oh, the sky's going to be falling next week, oh, the sky's going to be falling next year, and predicting recession after recession after recession that never came, all those chicken littles can step aside, because this data says sans some catastrophic black swan kind of an event, at least for the next 2, 3, 4 quarters, it's virtually the risk of a recession is as low as it gets. So that's what we got, and that's what the data says. And when the data changes, we'll change our minds, because we don't know anything. We just have a thesis on everything. And that's my chief security officer and my chief morale officer, and dogs that identify as horses. So I'm open for questions if you got them.
Thank you, Donald. Appreciate that. Are there any slides, Donald, you want to go back to or add additional commentary to, or anything you've had some frequently asked questions on or a lot of attention on recently?
I'm sorry. That silence. I'm so sorry. No, I think I pretty much covered it. I go to throw in the reefer slide in there as well, because it's even more. Flatbed's not quite as much. If I were to delve into it any further, I would have, last quarter, we delved pretty deep into the housing market. And what we pointed out was that we have a record number of millennials, or I should put it this way, we have a record number of people in that childbearing age, young couples, who are living in multifamily. So they're poised to be in a house. They were buying houses in, a great pace when mortgage rates were 3%, even when they were 4%, even when they were 5%. And then as they went above 5.5%, when they get to 6%, they grew alligator arms, and they moved into multifamily housing. If you look at the savings rates in that demographic, the savings rates in that demographic are higher than they've ever been for people that age. When I was that age, my cohorts did not save as much as they are, the millennials are right now. when my grandparents were there at that age, they didn't save as much as they are right now. So I think they're hunkered down in multifamily, knowing that we can afford the house of our dreams. That was tantalized, that was hung out there for them, and they're just waiting for rates to drop. If they start buying at the point at which they stopped buying, in other words, they stopped really as rates went from 5.5, mortgage rates went from 5.5 to 6. That's when they started, and then above 6 they stopped. And again, last quarter we showed you all the economics, how the monthly cost of servicing the mortgage, just the interest and the principal, when rates went from 2.75 to 7, and the nominal and the median price of houses went up a bit too, the cost just to service the mortgage literally went from just under $15,000 a year to over $27,000 a year, but virtually doubles. That's why they quit buying. But if you buy the premise that point at which they stop buying on the way up is the point at which they will start buying on the way down, then we're getting close. The 30-year mortgage over the last 40 years has tracked at 1.98%, because we did the math, above the 10-year Treasury, so 2%. And the 10-year Treasury is flirting with dropping below 4%, and mortgage rates, 30-year conforming mortgages in the last couple of weeks have just dropped down below 6%. They're at 5.9, 5.87%. That's great news, because I really believe that those millennials who've been saving, not all of them have. Every generation has people who can save money and people who can't, but those who have are prepared. And I think we get rates down to even just 5.5. So another 40, 50 basis points decline in the 10-year Treasury. And we're going to have mortgage rates of 5.5. And at 5.5, they're going to be able to afford a pretty nice little house, and they're going to go buy one. And you know what happens when you buy a house? Then you have to make it your home. And that drives truck tonnage. Not only the house itself and the appliances and things that go in it, but the furnishings and the things, the little niceties. So that's very encouraging. We talked about it last quarter in depth, so I left it out of this presentation. But I would bring you back and notice where rates are. Rates are now, the 10-year Treasury is trying to crack under 4%, and then the 30-year mortgage is already cracked under 6. That's both very bullish, and if that continues and we get another 50 basis points decline, I think things should get really interesting very quickly.
Thank you, Donald. We have one question. How do you suppose the recent current events, you touched on this a little bit, Donald, about how, the most recent data we have in the report for oil will now obviously be changed for the next report. How do you think based on the current events, that will impact what we see when the Q1 2026 report is finalized?
Well, it depends entirely upon the duration and the magnitude. Is oil going to go up, another leg, or are we just seeing the peak? Is it going to last at these levels, or is it going to retreat in the coming weeks? I would tell you that I think it's more probable that we're at or close the short-term peak, and that 6 months from now it will be lower. When I say we have a superior Navy and Air Force, the magnitude, if you ever looked at the stats, I've got some friends that work for the State Department, and we've talked about this. The magnitude by which our Navy and Air Force is superior is literally, against most countries, it's like we're flying World War II aircraft and they're flying World War I aircraft. It is dramatically different. And so we can handle it. We should be able to handle the conflict. One and two, bring it to a resolution. And two, we're the world's largest oil producer. We are the world's largest exporter of gasoline, the world's largest exporter of diesel. We have in the last 4 years vamped up our exports of liquefied natural gas so much to Europe, because the Europeans came to us when Putin said, well, if you won't support me taking over Ukraine, if you're going to talk about Ukraine going into the NATO, I'm going to cut off your natural gas. And so the Germans, the Europeans came to us and said, whoa, we don't want to be held hostage. We can deal with you. We know you're Americans. If we have a contract and you're making money, we can count on you. And they have spent literally hundreds of billions of dollars down in the Henry Hub area, especially in liquefied natural gas. And we're about 8-9 months away from being completely replacing the Russians and providing natural gas to the Eurozone. And we've essentially already replaced Russia as the provider of the refined products, the gasoline and the diesel. Us and United Arab Emirates, Qatar are providing all of Europeans' needs for their cars and their trucks. And that's completely pushed Russia out of the marketplace. And I don't expect Russia to get a chance to go back in either. So we're in a place now where we're not held hostage as we once were. Back in the 70s, we were we had to look the other way with who the Saudi family was and what the Saudi family represented, because we needed their oil, and we're just not in that place anymore. We're now the provider to everyone else, and we provide more than so much. We provide all of our own needs and have enough to be the world's largest exporter. That's tall cotton.
Thanks, Donald. We'll move on to the last question here. Can you sum up what the market report means, Donald, for the day-to-day broker for the next few months until the next chance we have for a special look at the next market report? What would you tell a broker before we hop off today?
Well, it's as you all know, on any given day, what you make over a week or a month is based upon making those decisions every day. Which way do I lean? Do I concede a little bit on price? Do I pay a little bit more for the truck? Do I take a little bit less for the shipper, or do I insist? Which way do you lean? And it's a penny or two a mile here, a penny or two a mile there, but it adds up. What I would tell you is the takeaway is very simple. I would look at the patterns that are in place and say, okay, in these types of transactions, I should be leaning this way. These types of transactions, I should be leaning this way. Very simple. Demand's growing. And so putting out bids that are only up 3%, 4% is lunacy. Because if you're very soon, if you're going to fulfill those loads, make good on those bids, you're going to lose money on the load. I mean, let's give a basic example. The spot rate for dry van in the last 13 weeks has gone up by, let's see, by 40 cents a mile. The spot rate for reefer, same time frame, it was gone up by 38 cents a mile. So telling somebody that you're going to be able to move a load for 5% more for the next year doesn't make sense. If we're seeing this kind of demand this time of year, putting bids out, for the longer the duration you put the bid out, and the less you bid, the more likely it is that you're either going to have to move that load for no margin, low margin, or a loss. Now, I understand if you put a 15% plus price bid out there, you initially you're going to have some pushback from your customers. Whoa. But all the trends right now say, quite frankly, you shouldn't put a bid out for very long duration. There's a lot of volatility, and if things are surging up, you're going to guarantee a price for the next 3 months, fine. But I wouldn't go a whole lot beyond that without making sure you had a fairly high magnitude of margin, because just when you see these kinds of runs, they don't just evaporate overnight. They tend to gain momentum. Isaac Newton was right about physics, but he was right about markets as well. Markets get momentum, and unless acted on by another equal and opposite force, they tend to run, to continue. And this one's got some momentum towards higher volumes, higher pricing, and it's happening in all modes. So that they compound the effect on each other. And so I would be that'd be the way I'd lean into. Hey, I'll move it. I'd love to help you, but I'm gonna have to get paid. I'd lean. That's the way I'd lean. And I think at the end of the day, you'll end up making another penny or two a mile as a result. You saw what was already happening to y'all on the margins. Margins down, margins down, margins down, margins down, margins down. Except in LCL, where it's a spot thing, and you charge whatever you want as long as you get the thing moved. So that's what I'd say. That's what I'd take away from it. And I'd sleep at night. I wouldn't worry about the economy.
Thank you, Donald. I appreciate that takeaway. I'm sure that helps some attendees go throughout their day and navigate the ups and downs of the industry.
Well, I appreciate you all.
With that, Donald, we will let you get back to analyzing things and see you for the Q1 2026 market report in a few months here. Everyone, thank you for your attendance today. And to check out the market report, make sure you visit tianet.org, where you can download it right there.
Thank you all for attending.
Thank you, Donald. We appreciate it. And thank you, everyone. We will see you in the next live stream. Thanks, everyone. Take care.